I'm Yeva from financialratios.com, and in this video I will provide you with a quick introduction of operating income margin. Profitability ratios are the ratios that show how successfully a company is running its activities, how profitable are its processes, and what the further tendencies for it are. There are two groups of ratios, margins and returns. Margin ratios show how the firm is able to translate money from sales into profits at various stages of measurement. The ratio used to measure a company's pricing strategy and operating efficiency is called the operating performance. The higher the margin, the better. When a company's margin is increasing, it is earning more per dollar of sales. The ratio is also known as operating profit margin, net profit margin, operating margin, operating income margin, or even return on sales, ROS. Now, to whom this ratio is important? The shareholders and owners, investors and creditors, managers and specialists. It is recommended to observe companies' operating margin ratio trends both in short and long terms. It gives an idea of how much a company makes on each dollar of sales. When looking at operating margin to determine the quality of a company, it is best to look at the change over time and to compare the company's figures to those of its competitors. In order to calculate the operating income margin, you must divide EBIT from net sales. EBIT equals earnings before interest and taxes, and is calculated by adding together net income, interest expense, and taxes. Net sales can be briefly described as sales and is calculated by deducting returns and discount for customers. An increasing value of operating margin indicates better performance of the company. Once the value starts decreasing, it indicates possible financial problems. It is worth mentioning that every industry has its own norms for this ratio. Operating margin of 19% means that it makes 19 cents before interest and taxes for every dollar of sales. 21% versus 19% means that a company manages its business processes better and risks less to face any financial problems. Operating margin of 15% means that it makes 15 cents before interest and taxes for every dollar of sales. 18% versus 15% indicate that this company had difficulties managing its business and soon might face financial problems. The higher the margin, the better. When a company's margin is increasing, it is earning more per dollar of sales. Please have in mind that in order to get a better view of a company's financial performance, calculating and analyzing other ratios is a must. Thank you for watching and see you in other videos.